We are through the second quarter here of 2026. We're going to go through some of the news stories, which ones have flip-flopped from the month before, as well as what areas of the market have responded as a result. When I spoke to you last month, the jobs report came back much better in the month of May than expected, and that was actually a bad thing as far as the market was concerned because there were heightened fears that the Fed could look at that and say inflation is still running high. We now have extra room. The economy is doing good to raise interest rates even further. What happened though in June flip-flopped that with the jobs reports coming back much lower than expected at only around 57,000 new jobs versus the 110,000 that were expected. In addition to that, the prior 2 months of May and April were revised downward by another 74,000 jobs. So overall, even though jobs report numbers were going down, which generally is not a good sign for the economy, the market was surprisingly happy probably with that result because that meant less of a likelihood that the Fed could be raising interest rates. In addition to that, we saw that the oil conflict with Iran made significant progress. So oil prices you saw came down, the jobs reports, like I said, came down. All of that works together to tell the Fed that, hey, we probably don't need to necessarily raise interest rates right now. We can hold and see, which is what they did in the month of June. So going forward, the news story is going to be, is this temporary truce with Iran, does that carry forward, lowering energy prices? And if so, how much? And is it enough to alleviate the inflation concerns that the Fed might have to keep rates the way that they are? So now let's jump in to see how this news affected some of the different areas of the market. The asset rotation piece that we've been talking about since the beginning of the year has continued to hold true, especially in the month of June. So even though emerging markets pulled back a little bit, it still leads the pack at around 23%. The Russell 2000, which are small U.S. companies, and real estate both jumped up over 3% for the month of June alone, putting them, Russell, right below emerging markets, real estate more like 17%, somewhere in that range. The S&P 500 and foreign equities sit below that, around 9 to 10%, so still a material gap between that and the highest performing categories. In the middle, we have buffered equity as represented by 15% January SPY. Fixed income is really just trudging along at barely 0.7, 0.75% so far for the year through the first half. And then we have the Shakers Bitcoin again struggling, pulling back another decent percent in the month of June, putting it at around 30% down for the year to date. Funny enough, though, you look back 3 years to annualized returns, and Bitcoin is leading the way. So these are how the current pieces have moved with the current news so far this year. So take this with you what you will for how you look at the different pieces for what you want to maybe put into your own portfolios and make sure that you have a mix that fits what your goals and objectives may be. We'll be back next month to see how some of these news reports have changed and how that may affect different areas of the market.